Hello, welcome back to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. Thank you for the comments and subscribers. I really appreciate it. I've got a new stock for you. I found it during the search for Ford and the review for Ford, which this channel was not very big on. I wanted to give this stock its due because I liked it so much. And really, no one's going to be searching YouTube for this stock. So this video is mainly as a thank you to you, the subscribers, for watching, commenting, and subscribing. No one's going to search for this company, and so let's just dive right into it. I found the company, by the way, by reading the Barron's magazine. I've been reading this magazine. This isn't a plug; they're not paying me, but I've been reading this magazine for 20 years. I get it every week, and there are good gems in here. And this last week, Al Root did a story on Magna International. Magna International is an engineering firm that is catered to outsourced automobile or OEMs that need extra engineering service. Magna characterizes themselves as a mobility technology company, and they have 4 divisions, which I'll read to you now. They've got the body and exterior, so they make lighter weight chassis, lightweight trunks and hoods and parts to reduce weight and increase mileage or efficiency in the vehicle. They've got a power and vision system, so front lightings for cars, as well as radar, and the 360 radar that's in BMWs is theirs. They've got power systems, so electric motors, electric drive trains, they've got all that kind of stuff. Seating systems, so interiors, as cars get more luxurious and kind of interior focus, less driving focus, but interior, they have lighting systems and seating systems, very cool. And they also do complete vehicles. And this is what Al Root's article was about. And this is why I think it's really interesting. You've got a lot of IPO money going out for electric car companies that are going to get just a windfall of jack. But they have no manufacturing capability. They either have to go build it, go buy it, or they can hire it. And I think in the interim, at least, they will hire it. And these guys could be a good beneficiary of a lot of EV IPO money that needs a car quickly to show to investors that they getting their money's worth. So I think this complete vehicle breakdown for them is going to be big. Let's dive into the numbers, the 10K, and then we'll come back. Before I get started, sorry. What this channel is about, really quickly, guys, I know it's just for the subscribers, but really quickly, this channel, we're hunting for top-line revenue growth, earnings growth, right? We look at Ebitda, enterprise level total, free cash flow, strong balance sheet, low price to earnings ratio, and that is the 5 key metrics that we look for. And I think this stock's gonna fit that. So let's dive right in. First and foremost, my hat's off to management for writing a beautifully written 10K. I really enjoyed reading it. It was laid out like I would have done it, with segmentation, profit by segment, sales and units by segment. Very well done. I liked they had a nice overview right up top so I could see, and I was surprised. This company is in 27 countries. They have 165,000 employees, 80 different processes. That means less, 40 billion in top line revenue, which is nice. And they have 346 manufacturing locations around the world. And when I read this, it's the way they describe themselves as entrepreneurial, which I like. Each division is siloed as its own enterprise and trying to make its own profit, innovation, and compete globally for their service. And I like it. They fight among each other for capital allocation on the ROIC, that return on invested capital. And I like that entrepreneurial spirit. And you can see it bear out in their results. Also, what I liked is Don Walker, the CEO, the chief executive officer, he's been there for over a decade. I actually went back and looked at a 10K in 2010, and he was still there. So what I like about that, if you remember my McDonald's video, McDonald's has turned over their CEO. This is their 3rd time. That's very bad because it's hard to judge the person at the top, their legacy, what their ability to accomplish on the historical review numbers if they're brand new. This guy's been there for coming up on a decade, if not longer. I didn't go back to see when he was hired. And the recent results are clearly under his leadership, and I like that. They also gave time to a lot of their other executives, the chief financial officer, as well as the president, and I think another technology individual, to kind of talk about where they're going in the future. They're all very forward-focused in what is mobility, what is going to happen to the car industry as we go from buying. We're now leasing. We're going to go from leasing to like a mass model where you're just renting an automobile and it's put in service to generate income and brought back to you. And they break that out really nicely. They also give you pretty good financial detail over year comparison and segmentation breakdown. Again, I liked reading it. It wasn't complex. I could understand it. The numbers were on for a first-time reader. My hat's off to them. Thank you for doing that. So, couple key points. One, body and exterior is 42% of revenue. So they are driven by body and exterior work. Next, it's power systems. So the electric motors, the electric transmissions are the next. That's at 30%, 29%. Seating systems, 14%, and then complete vehicle is 17% of 2019 revenue. And I expect, and Al Root in his article expects that to grow as these IPO companies look for someone who can build a car for them. Great. They talk about their customers. This is in no particular order, certainly in either importance or revenue that these guys derive from. This is just a list of the people they do business with. Ford, GM, BMW, Jeep, Cadillac, Daimler Chrysler, Jaguar, Mercedes-Benz, and Toyota, to name some of the big ones that I found. The new Jaguar I-Pace car that they've come out with, this is a vehicle that was built by these guys, so you can get an example of the type of car that they're able to. That's their all-electric, that's Jaguar's all-electric car. These guys built it for them. If they can do it for Jag, I'm hoping they could do it for another IPO company with a ton of Jag. So I like that prospect. They are dependent on the automobile industry. That's their sole business. If we are in peak fleet and peak cars come down, that would be a problem. I don't think so. I actually think that as we go to a mass model and people are and car utilization increases, but I think that means the turnover of vehicles will be faster, and you're going to want the car with the latest technology, so you're going to get a new car more frequently. Also, the last thing I want to bring up, which I thought, then I'll get to the financials in a second, but the last thing I think it's very important, page 59, really, 59? Yes, but that's not it. Shoot. Here it is. So so what I liked is they have a private equity pool of capital inside the company itself, and they were smart enough to make an investment in Lyft. And recently, in fact, this year they sold 5.4 million shares of Lyft, generating $231 million for the company. And I really like that. They've got another couple investments in the portfolio. You can read about it in the 10K that's showing that not only are they growing their own business and dealing with their own customers, but they're also betting on technology based on what they're seeing in the landscape. They're putting their hard dollars towards startups that could literally change the world. And I like that. And it's nice to see that management has the foresight to go do it. They're generating the cash that they have on hand to make those investments, and it's nice to see that they made one and exited one and made money. So here you've got like a little specialized private equity group inside the business. You can read about it in their 10K, and the cool thing about reading 10Ks is you don't get that on a stock screen. There's no screener that says people who bought in a Lyft and turned it as a private equity. That doesn't happen. You gotta have to pick a company and just read through it, and kudos for these guys for making it. Okay. I think that's all that I had on the notes. Yes. Let's go look at the financials. All right, here we go. Revenue. Revenue, 2011, $29 billion. it grows to almost $40 billion in 2019. That is an annualized 4% growth in revenue, 4% growth in revenue annualized, which is good. It's not great, but it's certainly better than inflation, 1.5%, 2%. But it's good. And here, that's what we're looking for. I don't want something that's crazy hockey stick. I want slow and steady that I know will churn out money. I also went and looked back at the 2010 10K. So 9 years previous. What did that 10K look like? How did it read? What did they write then to say what they were going to do now to see if it came true? And what I was pleasantly surprised by is this chart here. This is sales revenue in billions. This goes back to '01, so kind of the turn of the century. They're at $10 billion of revenue, and that grows to 2007 at $25 billion. It had a strong drop-off for the decline that happened in '08, and I expect you'll see the same thing this year with COVID, a strong dip. But it reverted back up, which is nice to see. And then that's like 22 billion. Go back to our model, picking up 2011, so a year after that, 28 to 40. So almost 20 years of continuously churning out top line revenue growth. Kudos to them. Let's take a look at Ebitda. Ebitda, $2 billion in 2011 to $4 billion in 2019. That is a 9% annualized growth rate. So you got top line revenue growing at 4%, earnings growing at 9%. That is margin growth. It's excellent, and it's nice to see that their business is starting to scale. As they get bigger and bigger, their systems are working better, and they're generating more profit. Kudos to them. Let's take a look at enterprise value, see how expensive the business is, see what kind of debt they have on it, and see the valuation. So here, first thing we'll take a look at is debt. $200 million in 2011, almost zero, to $5 billion in 2011. Definitely growth in the debt. Let's see how that stacks up. Market cap is share price times shares outstanding, 8 billion to 16 billion. So market cap is doubled in that time frame. Enterprise value of $8 billion to $21 billion, with a doubling of the market cap and a big step up in as a percentage-wise of debt, even though the debt itself isn't all that large. But that enterprise value here, $21 billion, divided by the, $4 billion way over here, of Ebitda, gives me a 5x enterprise value to Ebitda. 5 times. We have seen companies on this channel trading for 15, 20, 40 times earnings. That's 40 years of payback. This is 5. You buy the company now, 5 years later, it has generated enough revenue to pay itself back. And then from then on, you are playing with the house's money. That is fantastic, and that means it's cheap. What's interesting is it's been cheap for a long time. So you've got 4 at the low end, 4 times Ebitda to 5.5. That's cheap. I know companies around me locally that are private that trade, like you can buy, as an example, a local pizza chain for say 3.5 times Ebitda. Well, that thing is illiquid. You have to manage it yourself because there's no professional management. You put all your eggs in one basket because it's going to cost you some jack to go buy it. And for an extra turn and a half to 2 turns of Ebitda, I get liquidity, I get size, I get professional management, I get a great track record. That is a cheap stock. It is. There's no doubt about that. And then debt to Ebitda, like we like to see, is super low, less than 3 times. So this is 1.3 times levered as of fiscal year in 2019, trading at 5.5 times. It's currently 5.1, by the way. But if I do it on an annualized basis, it's 5.5. That is cheap. And what do we like to look for this channel, right? I'm not interested in the price. There's lots of traders, that's all they look at. They take the price, they take some magical dotted line, and it's below the 200 movie day average, therefore it's a buy. Well, who cares? How do you know it's a 200-day average, not a 50-day average? What about VWAP versus standard pricing? Like, if you give finance people metrics, they will come on with even more metrics to make things more confusing. What we do here is we buy cash flow. We buy it cheaply, we let it pay off for itself, and then when it's yielding free cash, we buy more cash flow cheaply, and it builds and it stacks on top of each other. And you look back 20, 30 years, and you've grown a small fortune because all you did is bought cash flow, and that cash flow stacks up in your brokerage account. I think this is a classic example. Let's look at cash flow from operations. Make sure the cash money is smell checking to the P&L. First up, cash flow from operations. Cash flow, 2011, $1.2 billion. 2019, $4 billion. That is a, drum roll, 16% annualized growth rate. That 16 smell checks with the 9% we saw in Ebitda. Really strong, both going in the right direction. That means the accounting department is booking expenses properly with cash going out, and they're both going in the same direction. You always want to make sure that Ebitda and cash flow from operations are moving in line with each other. Even if they move down, they need to move down in line and up in line together. Okay, Capex. Capex, remember, let's refresh. What is Capex? Capex is what they put back into their factories, what they put back into their infrastructure, the robots, the systems, the long-term capital investments inside the business that help them generate the day-to-day cash flow that they've been generating. What happens? 1.2 billion to 1.4 billion. That is so shockingly stable while cash flow itself is growing, which means that the cash they're investing it at a very high return on invested capital because it's growing cash flow on an increasing rate. We love to see that. Debt is what we would have expected with less than 1 times debt historically. When we look at the historical debt flows, you see a lot of positive and a lot of negative, meaning they borrow, they pay back. They borrow, they pay back. It's never all positive, which just means they're constantly borrowing every year. This is good. This is very good. Cash flow from cash flow to equity, free cash flow to equity. I'm summing across here. This is very strong. If I look at shares outstanding over time has dropped 5% annually over time. That means if you bought shares 9 years ago in 2011, your single purchase doing nothing else, forget about dividends, is now worth 5% more. I think the math works that way. It's 5% more than it used to be for every dollar they generate. Fantastic. If I look at the on free cash flow to the equity holders on a per share basis, it's grown from 15 cents to almost $8 a share. Amazing. Again, that is a kind of a combination of natural free cash flow growth, this enterprise-wide free cash flow growth from 73 to 2.4 billion, plus the fewer shares outstanding to divide this number into this means this grows even faster than that, which is excellent to see. Share price, average outstanding fiscal month, and then a yield. And I have to say, I was shocked to see a strong double-digit yield in this market when people are going nuts for yield. They're borrowing like crazy to put money in the stock market. They're buying on growth with no cash flow. Sometimes they're buying companies that have no free cash flow at all, just a promise. Here you got something that's spitting out last 3 years running double-digit average free cash flow to equity without borrowing to do so. That's fantastic. That's really good. I had to look at this several times. I liked what I saw. Please go through the 10K yourselves. Make sure I'm not making some fatal flaw here, but I liked it a lot. It's a 9.5% yield. So let's cover our 5 key attributes. Top line revenue growth, yes, 4%. Not double digit, not outstanding, but it's above inflation, so you're growing in real terms. I like that. It's strong, it's stable, and certainly when we looked over almost 20 years, it had continued to do that. Ebitda growing faster than top line revenue, so margins expanding, strong double digit at 9%. Free cash flow from operations, 16% growth, also growing in line with Ebitda. So I think it checks those 3 boxes. Debt, we saw debt was very low, and price multiple, 5.5 times is too cheap. It just is. And I think what's going to go on here, the forecast I'm going to show you is going to be based on a trifecta principle that I'm kind of coining in this channel. It's something I want to look for. It's something I look for personally. It's three things that I want to see before I make an investment. One, all five characteristics have to happen. That's to get in the gate. I got to hit those, and I got to buy it at a low price, which is the main one. The next leg of the trifecta is share price, reducing the shares outstanding. So as the shares outstanding are reduced, that my equity grows as a percentage of the cash flow it's generating. And so what is a, say, 8% annualized growth in Ebitda becomes a 10 or 15% on a per share basis because there's fewer shares outstanding every year. The last leg of the trifecta is market multiple expansion. And here you don't have any influence over it. It's the market. But when it happens, you get a hockey stick type curve. Please check out my Domino's versus Google IPO. This is what happened. Domino's went out cheap at 7 times. They generated positive cash flow for 15 years. You bought back shares, you gained percent ownership, and then at one point during the pandemic, the market said, hey, pizza is a really nice business to be in, and you go from 7x to 23x, and your return goes like this, and I think it's 5,000% return over that time period. Kudos to those who bought it. This, I think, could be similar. It's trading at double-digit yield when interest rates are negative. Enterprise value is at 5x, even though it's been cheap for a long time. As they grow, they're going to naturally fall into other indexes like the Russell 500, like 5,000. You've got the S&P that, as you've seen, Tesla and those have joined. The stock goes up because all the volume dives in because so many people have indexed their money, which is zombie money. I hate that stuff. You know that by now. But I think here, as they grow, as they pop up on people's screens, more analysts on Wall Street are going to write favorable reviews of the stock, which is going to turn more Wall Street's eyes to it. And as it does, volume will go up and this market multiple will expand. So that's the trifecta, right? Natural organic earnings growth, share buyback, and market multiple expansion. Those three line up to go whoop on a return. So very interesting. Let's forecast. Let's see what we got. Now, I'm going to naturally be very conservative. You know that we don't buy growth in this channel. I just have no confidence in it. They were growing Ebitda at 9%. I'm giving it a 5% given this year's Ebitda is going to be weak. It's not going to be 4.1. It might be half that. But I think long term, my target is 6.5 billion of annual Ebitda, which is essentially a 5% annualized growth from where we are now. They're doing 9, very doable. Market multiple, I'm giving it a 12 times multiple. You've got large engineering firms like Boeing out there that trade. I think Boeing's in the 12, 15% range, maybe even high. I think it might be 18. But the point is, engineering firms can have high multiples. This one simply does not because it's not big enough yet, but it'll get there. So I'm giving it a 12 times, which I think is reasonable. I've got the shares outstanding, less debt, which is almost none. Cash on hand, they have cash on hand, but I'm just not counting it. I want them to use that in their private equity, so I'm not counting that. Shares outstanding gives me a $225 price target. I'm sure all of you at this point in the video are Googling what the price is of the stock, and you're looking at it's currently around 50 bucks. I'm giving it a $225 target. That's a rich 5 times your money kind of deal. And I think that's where you get the trifecta. That's what's going on. Let's look at cash flow from operations. So again, same kind of thing. Cash flow last year, 7.9 natural cash, not enhanced by borrowing, $7.90. Next year, 2020, is going to be weak. They're not going to hit this $8.29. Not going to happen. But the point here is long-term or long holding. I'm going to grow that at 5% annually. I'm going to say in 2029, they need to be having $12.97 of free cash flow. If they do that and they get an average market yield, not the 14, that's above normal, it comes down to a 5% yield, that gives me a $257 price target. Now, comment here on yield and Ebitda multiples. On this channel, we have reviewed lots of stocks at this point. We have shown you yields on stocks that range between, say, 1% and 5%, maybe 6% sometimes. This is 14, I'm talking actuals, 14 times. So I'm bringing that back down to normal range of 5, which means the stocks can go up. Same thing for Ebitda. Ebitda, we've looked at things that have been 12, Walmart was in the 10 range, 12. You've got your Adobe, Salesforce, Microsoft in the high 20s. Salesforce is 40, Tesla's 100, Zoom is 1,000, right? So you've got this spectrum. Well, really the range should be much more narrow. And these guys, I'm giving them a 12 times. I think that's extremely reasonable. Let's look at where this stacks up. So you've got $50 is the current price. I've got two different estimates. One free cash flow, $257. Another $224 based on the EBITDA exit. I average those, I get $240. I come up to my IRR calculation, right? So the IRR is $50 is my in. I get a cash flow stream, which is mostly it's enterprise level cash flow, but they can either pay it out as dividend, they can either buy back stock, or they can go make private equity investments like they have been in Lyft, and I think kudos for them, they're going to do it. What that does, it gives me a stream of cash flow. When I look at the ins and outs and I annualize the IRR, right? This is just Excel. It's IRR on this stream, 35% annualized IRR. That is a fantastic return on a cash on cash. That is 7 times your money over a decade. That's both cash return and capital appreciation. Wow. That's definitely the most robust one we have seen in this channel. If I put it into a distribution curve, right, so it's currently $50. I hold all of the assumptions the same, and I just vary the purchase price. I get a range of IRRs over time, ranging from 45% if the stock should fall into the high 30s, down to a 28% IRR at 67. So I think it's a strong buy. I'm going to give it a good. Again, this is the best rating I can give. I don't have a great, but I think you can see that it's very robust. So that's Magna International. I think it's a very strong buy. I don't currently own it yet, but I'm looking at it. I'm going to look to buy it here shortly. Just freeing up some cash to do so. I've been plus 100% in the market in a while, but I'm going to start retooling the portfolio. I hope you guys liked the video. One quick comment. I want to say happy birthday to Warren Buffett. He's a mentor, and it's always nice to give a nod to an inspirational figure like that. And for something fun, I thought this would be a little interesting teaser at the end of the video. Let's take a look at Warren Buffett's net worth and see the magnification of compounding, why we buy cash flow and why we don't buy stock price, right? He's the oracle from Omaha. He is the quintessential man who buys cash flow. What has it done for him over 90 years? Well, at age 30, his net worth was $1 million. Hats off to you for having a net worth of $1 million at age 30. 30 years later, at age 60, his net worth was $4 billion. So in 30 years, he increased his wealth by 3.999 billion. Another 30 years after that, so the same time frame, his net worth goes from 40 billion to 90 billion. That is an increase of $86 billion in 30 years. So this change here, 30 years, 3.9 billion. This 30 years here, increase of 86 billion. How does that happen? He buys cash flow, and he buys on the cheap. That's why, because much like Magna, if you buy it, 5 years from now, it's paid off. That means the cash that comes to you, or the cash that they use internally, can be used to grow and buy another business at 5 times. And then 5 years after that, another business. And it stacks. And when it stacks exponentially, just like you're seeing here. And over time, later in life, you will be having a lot of jack come in the door, and you won't have to do anything for it. That's what this channel is about. That's why I look for cash flow, not the share price per se. But I hope you like this example. Happy birthday, Warren, Mr. Buffett. And I really appreciate all the support on the channel. Please subscribe, comment. Let me know what stock you want to see. And I hope you like Magna International. Take care. Bye-bye.